Hey everybody, David Shahady here. Today I want to talk about how you can reduce tax legally through investing in property. I'm going to use an example, and let's say you purchased a $500,000 property. That $500,000 property was generating you, let's say, a return of about $500 a week in rents. That works out to be roughly $25,000 a year of revenue that you're generating from your investment property. Now you're going to have expenses on your property, and I'm going to use some examples of what you would have roughly going out on that example. Let's say you're paying interest there of 3% on your lending, and you had borrowed that much money, you'd have about $15,000 in interest that you'd be paying a year. Let's add insurance, and let's say insurance is $2,000. Let's allow $3,000 in council rates and water rates. Let's allow $2,000 in maintenance. Let's allow $1,000 in bank costs, accounts. Let's allow the property to be vacant for 2 weeks. All of that would tally up to be about $25,000 in costs. So on your investment property, you would have $25,000 coming in and about $25,000 coming out in this example. So that's what we would call a cash flow neutral investment property. The property is bringing in enough money to be able to cover the costs that are going out on a cash basis. But here's where the ATO help us investors be able to, by helping us reduce tax through investing, they're incentivizing us to be able to go out and buy more properties. They allow us to claim this non-cash expense called depreciation. So on the example that I'm using, let's say that there's $15,000 of depreciation that we can claim on your $500,000 investment property. That would put the property into a $15,000 loss, according to the ATO. Even though that's not a cash loss, on paper, it would have lost $15,000 after depreciation. So that would allow us to then deduct that loss against your income tax. Now I'm going to use an example, and let's say that you're earning $70,000 a year. On $70,000 a year on 2020's income tax rates, you'd be paying around about $14,600 in income tax a year. If you had this investment property that was losing $15,000 a year, you'd roughly get about $5,000 back on a 30% tax rate because you can deduct that full loss against your income. So you'd reduce your $14,600 tax bill down to about $9,500. Now let's say you had 3 properties and they were all roughly generating the same return and losing $15,000 on paper, but covering their costs. You'd be able to claim on 3 investment properties the losses, which would bring your tax down to a position of only having to pay $852 a year in tax, down from over $14,600, which is huge. Now, the reason you can do that is if each property is losing $15,000, 3 properties are losing 15, that's $45,000. Take $45,000 off your 7-year income. According to the ATO, because they can let you write that off, you're only paying tax on $25,000. Property is a huge way to be able to not only build wealth for your financial future, but to get your tax bill significantly reduced at the same time. Thanks guys, and we'll see you soon. Cheers.